Hello, and welcome to another edition of Wealth Transparency. I'm your host, Ed Butowski with Chapwood Investments in Plano, Texas. And I'm joined today by Michelle Connell, who is the CEO of Portia Capital Management in Fort Worth, Texas, and Andrew Tang, who's the Chief Investment Officer at Turner Financial Group in New Jersey. Each week, we take headlines that are not really front page stories, but talk about what those storylines mean to you and your investment portfolio. And we try to direct you on what to do as a result of them. So thank you very much for joining us today, Andrew and Michelle.
Thanks for having me.
So as we do every week, I just kind of start and get right into it. Markets are sitting at all-time highs right now, and earnings are carrying the rally, meaning that earnings are coming out from the second quarter, and we're starting to see that those earnings are being beat, or in some cases being, really beat. And, so that's a little different than the expectation of earnings, but earnings are absolutely leading the way. Michelle, why don't you take us through how you see the market right now and the valuation on the market?
Well, even though we're at all-time highs, we've had a rotation away from a lot of the technology and AI names, and you've seen a broadening out with the equally weighted S&P as well as the Dow Jones index in the last month or so. And the markets are getting really selective in terms of what they're going to reward. Yes, we've had some great earnings, but at the same time, for those that have disappointed, it's tough. So if you're like a Tesla or you're an Apple and it's not quite good enough, you're going to get hit. So you need to be careful not to just own an index blindly, because if they have these huge weightings and one of those names gets taken down for disappointing, it's going to hurt you. It's going to hurt the index.
And Andrew, it used to be, and you're very tech oriented, but you used to have just buy tech and you're going to be fine. But as Michelle said, the indexes and the investing world is starting to broaden out, which is a good thing because it shows more support for the overall market.
Yeah, absolutely. I echo what Michelle is saying. And not surprisingly, as expected, 75 to 80% of the S&P companies have beaten earnings. And companies within the index is growing anywhere from 9 to 10%. So it is the low side of the double-digit growth. And at the same time, when prices catches up, and you'll see that when prices catch up, you will see that the market becomes more unforgiving, right? And so you'll see, I think especially for a memory maker in Korea, South Korea, SK Hynix, when their earnings did not meet the street's expectations, then it sold off tremendously. Add to it that the investors have, added leverage to it. So the speculation nature of it. So that's why there's so much market volatility. But I agree with what Michelle is saying is that as the market broadens out, I think it's going to be more of a stock picker's market. You can't just blindly buy into an index and then hope for the best, so to speak. So it's really an opportunity for money managers, allocators, and you and I alike to really go out there and find the better companies out there.
I think all three of us can remember there was a time where anything that had the word nano attached to it was a great buy when nanotechnology was taking a hold of the market. And nowadays it's AI. Anything that's AI is good. But now we're starting to see the spending from AI, and now people are looking for results as a consequence of that AI spending. So Michelle, are you starting to see companies, stock prices not do as well because they're not capitalizing on the AI spending?
Yeah. And on the other side of that, you're starting to see companies that weren't getting rewarded are getting rewarded because their spending's starting to pay off. Like Amazon really came through. They have their Amazon Web Services doing very well. They're making their own chips, or they're partnering with us for their own semiconductors. And they've done very well this year. And then you have Microsoft, which was getting punished in the last 3 months. They seem to be turning things around, and the stock's up 23% in the last 3 months or so because their heavy investments are paying off. So you just can't stay in the lane of, okay, I'm going to buy memory and it's going to be great and they're going to continue to do well. The sales may do well, but you have to look at the spending, the infrastructure spending, and the margins. Are these margins going to be short term or are they going to be long term? And so you really have to know what part the company is going to play in AI and whether it's short or long term. And if all this spending and investment and debt issuance is going to pay.
Yeah, I don't remember a time where margin compression was killed as badly as I saw with Mercado Libre yesterday.
Yeah.
They announced fantastic earnings, but they had margin compression and the stock went down 7%. So having said that, Andrew, are you seeing the benefits of AI capital expenditures yet in earnings of companies, or is it still something we're waiting for?
It's still something that we're waiting for because, Wall Street is ever so short-sighted and short-term viewed because traditional investment bank and analysts, they're still looking at the cash flow model, right? The cash-free cash flow model. And therefore, it is very difficult to evaluate a company if they don't see the revenue or the expected revenue come in in the near-term future. And so it is also very easy to counter the estimated forecast for the revenue growth when you're just simply not seeing it, with the AI spend, so much that's going in. And I'll take the extreme in this particular case scenario. For example, SpaceX, okay? SpaceX AI is the new entity's name. They reported 2.56 billion in a single quarter. Okay. And the Wall Street is estimated, Goldman Sachs is estimated that the AI revenue will hit about 15.6 billion. So think about 2.5, it's going to grow to 15. And then by 2030, it's expected to grow to 322, somewhere around there. So you see this huge leap there. It's great, but guess what? The street doesn't trust it. The street say, show me. Before we can be comfortable with this type of valuation. And I think, the market rally broadening, it also has to relate to the spending and the capital expenditure broadening as well. So it's not just going all into the chip makers. It is broadening out as it spreads because as the infrastructure grows, it goes into power, it goes into construction, it goes into supporting systems, right? And then it trickles all the way down to consumer spending and the food service, vendors and the businesses that feed the people, right? So, and also the financing portion of it, as spending requires so much capital, then the financial institutions also have their hand in the, in the revenue as well. So I think in the long run, this whole AI spending doubt, it's going to, start to disappear or level off. But in the meantime, it just sounds very legitimate that, hey, you're spending all this money and then we're not going to see the revenue down the road. So I think it's just going to take a little more time for this whole AI spending and turn into revenue to unravel.
Yeah, so I think a lot of what we're saying here is that, these are, finite decisions, company by company. But from a macro perspective, oil remains the main driver of the stock market right now. And Michelle, when I guess, if you could predict when the end of the Iranian war is going to happen, then that would be magnificent. But nobody knows for sure when oil is going to turn around. But you can, without question, know how impactful oil prices are to stocks.
If I could predict the end of the war, I'd be making some large wagers in the prediction markets. And I don't even know where those stand right now. Andrew probably does. Maybe he could weigh in on that. That could give us an idea of how close we are to the end of the world war. That being said, oil does and gasoline prices has a huge impact, maybe not on the upper 5% or 2% or whatever, but I was doing some reading and right now for the average middle class or lower middle class and below consumer, they're spending more than 10% of their monthly budget on gas, to get to and from their jobs. That's a lot. I mean, we're not hit by that, but if you're somebody that's making close to minimum wage and trying to make your rent and you have to spend that much more on gasoline, it's really tough. So where that starts to funnel through is that those individuals have less to spend on discretionary items that they usually have room in their budgets for, most especially entertainment and restaurants. You were starting to see some of that actually come through in the earnings announcements of the restaurants recently. Some of them have been hit really hard because even if it's like a McDonald's meal and it's gone up from like $6 to $8, a lot of people are having second thoughts on that.
And so, along with second thoughts, a lot of people are having second thoughts on when they're going to buy their next home. Mortgage rates are starting to ease a little bit, but houses are still very expensive. And housing is a huge portion of the CPI when that's announced. So, how do you square, Andrew, both the easing of mortgage rates but the expenses of houses? Do you see that changing anytime soon, where you'll start to see more home purchases?
Yeah, I think there's really no letting up in this situation because the 30-year fixed, mortgage rate, jumbo mortgage rate is 6.77%, where Freddie Mac's is 6.69. Again, that's if you have perfect credit. And so, we're seeing the medium homes priced at roughly about $435,000, near a record high. It's crazy. It used to be $100,000, then it jumped up to two. That wasn't even too long ago. I'm talking only just, 10, 20 years ago. And in this situation, you're going to continue to see homeowners, they don't want to transact. They don't want to transact because they don't want to give up their mortgage. They're still somewhere around 3 to 5%. And so from that point of view, you're not going to get enough inventory. And then with the higher prices of materials and labor, you're going to see less home builders are willing to build the homes first unless they have the demand. And even homes that are on the market right now is taking longer to close because access to capital is still quite limited. It's still quite restrictive. And so with the Fed indicated that rates are most likely going to stay at these levels without any dramatic increase or decreases. I think, the situation is not going to improve, but it will convince the buyers to start making purchases instead of waiting for rates to come down. So I think, overall the situation is bad, but the first-time home buyers and the buyers to be, I think they will start to transact. But it all depends on the amount of inventory out there. So supply is still an issue.
Before we go to the next topic, I just want to make a side point on terms of what Andrew just said. I thought it was interesting because I thought that one was correlated to the other. You've got birth rates for women between 30 and 35. 40% of those women are childless. Now, 10 years ago, it was only 29%. And I think there's some correlation there because housing is so expensive and people are delaying having, getting married and then delaying having children. But 40% of younger women not having children by the age of 35, that is not good for our economy. So we have to do something about this affordability so that people can have hope that they can have a house one day.
And the first-time home buyer, the age of a first-time home buyer has been pushed up to 40. So
there you go. Okay. So it does have some effect, and that is going to affect our economy if we don't have a decent birth rate, right?
Yeah, absolutely. Yeah.
Yeah, we're down to 1.3 children per family, I think.
Yeah.
Yeah. And 2 is the target, right?
Yeah.
We're not replacing ourselves, so yeah, we're heading towards,
Well, we all
We're
three
heading
live
towards
in a world where we're
integration.
forecasting or hoping that reports and economic data will come out to support a strong economy and therefore a strong market. The jobs numbers are coming out tomorrow, Friday. What do you look for in those jobs numbers, Michelle?
They seem to be still somewhat strong. So that gives me encouragement in the short run. But when you look at larger corporations, they're not creating a lot of jobs. And therefore, the individuals that are unemployed are looking at a much longer period of being unemployed. And so I think it's something that we just can't, keep looking from Friday to Friday. We need to look at the long-term trend, especially as AI becomes more prevalent throughout the economy. And AI, whether it's being used or not, it's slowing down the employment process from what I've read. Getting through, the quagmire of resumes out there. It's really hard. And you've got the AI, guard out there and you're trying to get your resume through. If you don't know somebody, it's really making it difficult. So I think we need to keep watching that, but look at it in the long term.
So another place to be looking at that we don't often talk about in investing, we talk about the United States, Europe, Japan, China, but we often avoid talking about Africa. And Africa, the only thing I know about Africa is that there's 59 different languages spoken on the continent of Africa. One of those weird little facts, but we don't know a lot about Africa, but we do know that there's a lot of rare earth minerals there. Andrew, can you tell us a little bit about why that's so important and how you might invest to take advantage of that?
Well, I'll tell you, not a whole lot of opportunities for the U.S. investor to take advantage of that. And one country in specific that it's well aware of that decades ago, and that's China. And China knows that Africa has very rich in rare earth materials. And right now, China processes about 90% of Earth's rare refinery capacity right now. And it makes sense for China to help these African nations to build out the infrastructure. And we've seen it. And China very often provide these loans and hoping that, they will in return, be able to pay back, or if they can pay back, then the country will make compromising terms and agreements with China, like controlling the ports or access to major arteries and et cetera, et cetera. So in this particular strategy, we can see how China is playing the long game of trying to position themselves to be a predominant player and to be the continuous winner in this particular space. To offset that, I think I've said it before, is that the U.S., we are in the process of creating new plants, new refining. Again, it's not so much about accessing the raw material. It's more about refining the rare earth elements. And another good offset to that is through tech and innovation, the manufacturers are able to use materials that are more broadly available versus the need of using rare earth material. A perfect example is cobalt. Cobalt used to be the crucial ingredient to make lithium-ion batteries, right? But not anymore. Now, through tech and innovation, the manufacturers are able to use more commonly available elements to make these batteries and still have the same amount of capacity. So this is one of the good things that we're seeing that are happening to offset this desperate situation.
Well, another good thing that we have are the two of you sharing your thoughts every week with us. And there's a lot of work that goes into preparing for this. And I hope everyone watching, takes the time to reach out to Michelle Connell with Portia Capital Management in Fort Worth, or with Andrew Tang with Turner Financial Group. I really appreciate everybody watching, and please share this with others. We're trying to build up our following, and any help you can give us, we'd appreciate. So thank you very much to both of you.
Thanks for having me.
Thank you, Ed.